We now move on to Article 4, or the concept of residence in tax treaties. Now, the concept of residence in tax treaties is one of the most important criteria, because unless and until you are a resident of a particular country, in most of the treaties you will not be able to claim a benefit of the relevant treaty. Now, what I mean by this is, let's say for example, there is a company in Mauritius who wants to take the benefit of the India-Mauritius Treaty and claim an exemption of the capital gains which may arise on sale of shares of an Indian company. This Mauritius company has to prove that it is a tax resident of Mauritius. If they do not prove that they are a tax resident of Mauritius, they cannot claim the benefit of the India-Mauritius Treaty. A US person or a UK person or a Canada person or any other country person who is not a resident of Mauritius cannot claim the benefit of the India-Mauritius Treaty. So therefore arises the question, how do you determine the concept of residence in tax treaties? Like I said, the concept of residence is generally covered in Article 4. While over the years, various countries have designed various clauses, typically, if you look at Article 4, the composition of Article 4 is divided into 3 clauses. Article 4(1) defines the concept of resident, right? So what is a resident? Is it a person who is incorporated in a country? Is it a person, insofar as individual is concerned, who is a citizen of that country? Is it a company whose management lies in a particular country? All these criteria are mentioned generally in Article 4(1), which defines what does a resident of a particular country means. Article 4(2) tells that if you apply Article 4(1), okay, in case of an individual, and this individual becomes a resident of not one but more than one country, right? In that case, how will you decide which country should he be considered a tax resident of? So let's say if we were applying the India-USA tax treaty, right? And by virtue of application of this, there is a gentleman, Mr. A, who becomes a tax resident of India as well as tax resident of US, right? Like I told you, there could be different criteria by which different countries can take care of when a person would become a resident. In that case, he has to be ultimately a resident of one country, right? So whether he'll be a resident of India or USA, there are certain criteria which are defined in Article 4(2), which one needs to look at to find out whether this person becomes a tax resident of India or USA. And this is called the tiebreaker rule, but in case of an individual. Article 4(3) similarly contains the tiebreaker rule for a company. Now, what can happen is, if you remember, in India, an Indian company is always considered a tax resident of India, which means that an Indian company is always going to be a tax resident of India. Think of a situation where the management of this company is entirely based out of, let's say, Netherlands, right? If that be the case, and Netherlands says that if the entire management is in Netherlands, you'll become a tax resident of Netherlands, this company may end up becoming a resident of India by virtue of its incorporation, and it may become a resident of Netherlands by virtue of the management. In such a case, how do you decide which of these two countries should consider it as a resident is something which is covered by Article 4(3). But as we discuss all this, why is the concept of residence important? The concept of residence assumes importance because it determines the scope of application of treaty, which means that whether or not a treaty is applicable to a particular person is determined by whether or not he is a resident of one of the two countries who are entering into a treaty. Here I would like to point one thing, that certain clauses are applicable based on citizenship or nationality as well. right? When you look at non-discrimination, etc., those clauses are also applicable to citizens of country who may not necessarily be tax resident. But that is something which is not being discussed right now. We will discuss that as we discuss Article 23, 24, etc., right? The second is allocate taxing rights between treaty partners. Now, what this means is, if you are looking at a treaty between country A and country B, if a person is a tax resident of country B, then generally B has a right to tax the global income of this person. As against this, if he is a resident of country A, then country A has a right to tax his global income, right? The treaty normally contains different provisions which give the right to tax a particular income to the country where the person is a resident. Therefore, the concept of residence helps in allocating the taxing rights between treaty partners. It helps you to ascertain the fiscal domicile of an entity, and it also helps you in resolving double taxation cases. Now, what that means is, normally the right to tax is given based on the residential status of a person, right? If by application of Article 4, a person becomes a resident of country B, A may agree that we are going to give up our right to tax, right? In which case there will be no double taxation. Or B may say that if this person is a resident of my country, I am going to allow you a credit for any taxes which would have been withheld by A. So it helps you to resolve double taxation cases. These double taxation cases could be the case where a person becomes a resident of two countries, or there is a double taxation in the source and the resident state.